In today's volatile financial landscape, diversifying your portfolio with precious metals like gold has become an increasingly attractive option. As a tangible asset that has stood the test of time, gold bullion offers a unique combination of safety, liquidity, and potential for long-term growth. Today, we'll delve into the reasons why investing in gold bullion can be a lucrative financial decision, analyze its historical performance, compare it to other asset classes, and discuss potential drawbacks and strategies for mitigating risks. Let's start by looking at the historic performance of gold.
Gold has a long and varied history as a store of value. Throughout the centuries, gold has been used as a form of currency, a medium of exchange, and a hedge against economic uncertainty. In times of financial instability, investors often turn to gold as a safe haven asset, driving up its price. As a result, gold has consistently outperformed other asset classes during periods of economic turmoil. For example, during the 2008 financial crisis, the price of gold soared as investors sought refuge from the stock market collapse and the devaluation of currencies. Similarly, during the COVID-19 pandemic in 2020, gold prices reached record highs as investors sought to protect their wealth from the economic downturn. Here we have a 30-year history of gold prices. As you can see, while there are bumps along the way, the overall trend is upwards. We are currently in a period of rapid increases in price. This indicates that investors are uncertain about the future and are seeking a safe haven for their assets. While nobody can guarantee what the future will hold, there appears to be an increasing acceleration in the price of gold.
I think you will agree that gold has been a reliable store of value throughout history, with prices generally rising. According to data from the World Gold Council, gold's price has increased by approximately 500% since 1971, outperforming many other asset classes during this period. In contrast, the S&P 500 index has returned around 300% over the same time frame. There are many factors that influence the price of gold. These factors include both domestic and global influences.
Several geopolitical and economic factors can influence the value of gold. For example, political instability, wars, and trade disputes can drive up the demand for gold as a safe haven asset. In addition, central bank policies, inflation rates, and interest rates can also impact the price of gold. For instance, when central banks implement quantitative easing measures or lower interest rates, the value of fiat currencies tends to decrease, leading investors to turn to gold as a store of value. On the other hand, rising interest rates can decrease the demand for gold as investors seek higher-yielding investments. The strength of the US dollar also plays a significant role in determining the price of gold. Since gold is priced in US dollars, a strong dollar can make gold more expensive for investors holding other currencies, leading to lower demand and a decrease in price. Conversely, a weak dollar can make gold more affordable for international buyers, increasing demand and driving up the price. In addition to these economic factors, market sentiment and speculation can also influence the price of gold. Traders and investors may buy or sell gold based on market trends, news events, or other factors that can impact supply and demand.
Now, while investing in gold bullion offers many benefits, there are also a couple of potential drawbacks to consider. First is volatility. Gold prices can be highly volatile, with significant price swings occurring over short periods. It's easy for investors with short-term goals to sell their gold when immediate returns seem unlikely. Second is storage costs. Storing physical gold requires secure facilities and insurance, which can add costs to the investment and reduce your rate of return. These risks can be minimized in several different ways. The first is diversification. I know you're familiar with this concept. It's important that you spread your investments across different asset classes, including stocks, bonds, and real estate. Second, consider hedging. You can use derivatives or other financial instruments to hedge against potential losses. There are various types of derivatives, including options, futures, forwards, and swaps. Each type of derivative has its own unique characteristics and can be used for different investment strategies. Third, look at different storage options. Consider using secure storage facilities or insurance policies to protect against theft or damage. Some gold dealers offer secure storage instead of sending the bullion directly to you. Now, in conclusion, we've seen that the price of gold is influenced by a variety of factors, including supply and demand, inflation, geopolitical tensions, interest rates, the strength of the US dollar, and market sentiment. Understanding these factors can help investors make informed decisions when buying or selling gold, and navigate the often volatile and unpredictable gold market. Investing in gold bullion can be a lucrative financial decision if you are willing to take on some level of risk.
Thank you for taking the time to watch our video. We truly appreciate your support and interest in our content. We hope you learned something valuable from this video. If so, please click the thumbs up, like button to let us know. Now, we recommend you watch this video next. It will further boost your knowledge and skills in this important area.